Right now, the Australian government is about to make changes that could reshape how every single one of us builds wealth. The May 2026 budget drops on May 12th. And if you're investing in property, shares, super, or even just trying to get ahead, this one's personal. Here's the thing most people won't tell you: budgets aren't just boring spreadsheets politicians fight over, they're signals. They tell you where money is flowing, where it's being taken away, and most importantly, where opportunity is hiding in plain sight. So let's break down exactly what's coming, what it means for your money, and what smart Australians are doing right now to stay ahead. Let's start with the biggest story. The capital gains tax discount is almost certainly getting slashed for property investors. Right now, if you hold an investment property for more than 12 months, you get a 50% discount on the capital gains tax when you sell. That means you only pay tax on half your profit. It's been this way since 1999. But that 50% discount has cost the government roughly $21.8 billion this financial year in lost revenue. And here's the kicker: Treasury data shows that over 83% of those benefits flow to the highest income earners. The government is calling this an intergenerational equity issue, and they're not wrong. Young Australians are increasingly locked out of the housing market unless they inherit wealth or get family help. So, what's the likely change? The strongest signal points to the CGT discount being cut from 50% down to around 25% to 33% for established investment properties. New housing may get preferential treatment, meaning a higher discount or full exemption. The government wants to discourage speculation on existing homes while encouraging developers to build more supply. Now, what does this actually mean for you? If you own an investment property and you've been sitting on big unrealised gains, your after-tax profit on a future sale just got smaller. Let's say you bought a property for $500,000 and it's now worth $800,000. Under the current 50% discount, you'd pay tax on $150,000 of that $300,000 gain. Under a 33% discount, you'd pay tax on $200,000. That's a meaningful difference. And here's a critical question everyone's asking: will existing properties be grandfathered? The honest answer is nobody knows for certain yet. Some analysts believe existing properties purchased before the legislation commences would likely keep the current rules. But other analysts has warned that no grandfathering is anticipated, meaning even properties you already own could be affected going forward. This distinction matters enormously. If there's no grandfathering, investors holding properties with large embedded gains might face a bigger tax bill than they ever planned for. And if there is grandfathering, it could actually lock people into holding assets longer, reducing market liquidity and keeping supply tight. Either way, the uncertainty itself is a risk you need to factor in. But here's where it gets interesting. If the discount is only reduced for established properties, this could actually push more capital into shares, bonds, ETFs, and new housing. Now let's talk about the second big change: negative gearing. Treasury has been modelling a cap that would limit negative gearing to a maximum of 2 investment properties per person. Right now, there's no limit. You can negatively gear 3, 5, 10 properties and deduct all those rental losses against your salary income. That's about to change. Tax professionals are already warning this will create an accounting nightmare, especially for people who do their own returns. And there's a real concern that reducing incentives for property investors could shrink the rental pool at exactly the wrong time, when rents are already under pressure. But from a pure investment strategy perspective, this forces a shift. If you can only negatively gear 2 properties, the days of building a massive leveraged property portfolio with generous tax offsets are numbered. Smart investors are already rethinking how they structure their holdings. Some are looking at holding properties through company structures where capital gains are taxed at the full company rate of 25% to 30% rather than relying on the individual discount. Others are consolidating, selling underperforming rentals and redirecting capital into higher yield assets that don't depend on tax concessions to make the numbers work. Now here's what barely anyone is talking about: Division 296. This is the new superannuation tax that starts on July 1st, 2026, just weeks after the budget. If your total super balance is above $3 million, your earnings on the portion above that threshold will be taxed at 30% instead of 15%. And if you're above $10 million, that rate jumps to 40%. Now, before you panic, this only affects around 90,000 Australians with balances above $3 million dollars and roughly 8,000 above $10 million. Dollars. But here's why it matters to everyone. It signals a philosophical shift. The government is saying super is for retirement, not for building dynastic wealth with minimal tax. And if you're a disciplined saver who's been maximizing contributions for decades, you could cross that $3 million line sooner than you think, especially with indexation only recently being added. The good news is the original proposal included taxation on unrealized capital gains, meaning you'd pay tax on paper profits even if you never sold. That was scrapped in October 2025. Under the final rules, only realized earnings are taxed, and both the $3 million and $10 million thresholds are indexed to inflation. That's a significant relief for long-term holders. For those affected, the strategies are already shifting. People are looking at investment bonds, which are taxed internally at up to 30% and can be withdrawn tax-free after 10 years. Others are exploring super recycling, where you withdraw tax-free amounts if you're over 60 and redirect funds into a spouse's or adult child's super. Now zoom out for a second. All of this is happening against a backdrop that makes this budget even more critical. The war involving Iran has closed the Strait of Hormuz. Oil has spiked past $120 a barrel, and fuel costs are hammering Australian households and businesses. The government halved the fuel excise at the start of April, saving drivers about 26 cents per litre. That's costing the budget $2.5 billion for just 3 months. There's speculation it could be extended in the May budget, but at that cost, it puts enormous pressure on the fiscal bottom line. On top of that, inflation is rising again. The RBA has flagged that the unemployment rate is expected to climb gradually from late 2026, and Treasury has downgraded its productivity growth outlook. This is not the backdrop for passive, set-and-forget investing. This is the environment where you need a strategy. So let's talk about the income tax changes too. From July 1st, 2026, the lowest marginal tax rate drops from 16% to 15% for income between $18,201 and $45,000. And there's a new $1,000 standard tax deduction for work-related expenses starting in the 2026 to 27 financial year. These aren't game changers on their own, but they put a little more cash in your pocket, and every dollar matters when you're building wealth. So what should you actually do with all of this? Here's the shift in mindset. This budget is essentially telling Australians that the old playbook, buy multiple investment properties, gear them up, claim the losses against your salary, hold for the CGT discount, and ride the wave. That playbook is being rewritten. The new playbook looks different. It's about diversification. It's about understanding that shares, ETFs, bonds, and new housing developments may now carry relatively better tax treatment than established property. It's about being strategic with super, not just throwing money in and forgetting about it. It's about structuring your investments deliberately, not just chasing tax deductions. If you're early in your wealth building journey, this is actually a moment of opportunity. While over-leveraged property investors scramble to restructure, you can position yourself in asset classes that benefit from these shifts. And if you're further along, it's time to model the impact. Run the numbers, talk to a financial advisor. Don't wait until the rules are locked in. This budget isn't just policy, it's a turning point. The government is reshaping the incentive structures that have driven Australian investing for 25 years. Those who see it clearly and move now will be the ones who benefit most. If this helped you see the budget differently, hit subscribe and turn on notifications. Thanks for watching, and I'll see you in the next one.